The S&P 500 just gained 1.11% in a single session, but the Nasdaq moved exactly zero. If those two numbers tell the same story to you, this video is going to change how you read markets. When the broad index and the tech-heavy index decouple like this, something structural is happening beneath the surface. The VIX dropped 8% to sit at 17, which means fear is leaving the building. But the question you actually need answered is where the capital is flowing and whether today's move has any weight behind it. Start with the number most people glanced at and dismissed. VIX at 17, down 8% on the day. That drop is not cosmetic. The VIX, formerly the CBOE Volatility Index, measures the market's 30-day implied volatility, priced into S&P 500 options. When it falls 8% in a single session, institutional desks are actively unwinding hedges. They are not holding puts for protection anymore. That is a conviction signal, not a sentiment survey. Here is the number that matters. 17 sits comfortably below the long-run average, which has historically hovered around 19 to 20. A VIX at 17 is not complacent. It is not the 12-handle readings we saw during the low volatility regime of the mid-2010s. But it is signaling that the acute stress phase has passed, at least for now. What smart money actually watches at this level is the term structure. When front-month VIX falls faster than the 3-month or 6-month contracts, it confirms the market is pricing in near-term calm rather than a durable reduction in risk. If the term structure is in contango, short-dated VIX below long-dated, that is consistent with a genuine stabilization. If it is inverted, the relief rally is renting, not buying. The actionable insight here is straightforward. A declining VIX in the 15 to 18 range has historically been an environment where equity risk premiums compress and multiples expand modestly. That does not mean buy everything. It means the penalty for holding equity duration, longer duration growth stocks in particular, is lower than it was 2 weeks ago, when the VIX was running above 22. Position sizing, not directionality, is what changes in this regime. Here is the part of today's tape that deserves far more attention than it received. The S&P 500 gains 1.11%. The Nasdaq finishes flat. Those two outcomes happening simultaneously is not a coincidence. It is a map of where capital moved today. The S&P 500 is cap-weighted but broad, 500 companies across all 11 GICS sectors. The Nasdaq composite is heavily concentrated in technology and communication services. When the S&P outperforms the Nasdaq by over 100 basis points in a single session, the math is telling you that today's gains were driven by the sectors the Nasdaq does not own heavily. Think financials, industrials, energy, healthcare, and consumer staples. This pattern has a name, sector rotation. And in 2026, with interest rate policy still commanding attention and the AI infrastructure build-out entering a more selective phase, rotations like this one deserve serious scrutiny rather than a headline and a shrug. Consider what a 1.11% S&P gain with zero Nasdaq participation implies about breadth. The advanced decline line, the number of stocks rising versus falling, would need to show broad participation for this to be a sustainable move. If the S&P gained on the back of heavyweight non-tech names, while most stocks were flat or negative, the breadth is deceptive. If the advanced decline ratio was genuinely positive, that is a healthier signal. The actionable read. If you are running a portfolio that mirrors the Nasdaq's composition, heavy mega-cap tech, you did not participate in today's move. That is not necessarily a problem. But it is a data point worth tracking because sustained S&P outperformance versus the Nasdaq historically precedes either a broader recovery in value and cyclical sectors or a top in the leading tech names as money takes profit and redeploys. Both scenarios matter. One of them is much better for your portfolio than the other, and you need to know which one is playing out, not financial advice. But that is the analytical framework serious investors are running right now. One day of data is a data point. 2 or 3 days is the beginning of a pattern. Here is exactly what institutional desks will be watching in the 48 hours following today's session and what each signal means for the durability of this move. First, volume. Today's 1.11% gain means very different things depending on whether it came on above average or below average volume. A strong move on thin volume, common in mid-June as institutional desks begin reducing exposure ahead of summer, is often referred to as a low-conviction rally. It can extend further, but it lacks the institutional buying pressure that sustains moves over days and weeks. If tomorrow's session holds the gains on rising volume, that changes the interpretation significantly. Second, follow-through in the sectors that drove today's move. If financials or industrials led today, do they open strong tomorrow? Sector momentum tends to persist in short bursts of 2 to 5 days before mean reverting or accelerating. The first follow-through day, after an initial sector rotation signal, carries disproportionate information content. Third, and perhaps most important for readers of the macro environment, any scheduled economic data or Fed communications in this window. In June 2026, the market's sensitivity to rate path signals remains elevated. A single sentence from a Fed official that shifts expectations by even 10 basis points on the next meeting can override everything the tape was signaling technically. The broader principle worth internalizing, a single-day market move, even a clean and well-structured one like today's, is a hypothesis. The subsequent price action is the test. Serious investors do not commit to a narrative on day one. They watch, they size accordingly, and they update when new evidence arrives. That discipline, not prediction, is what separates portfolios that compound from portfolios that chase. We opened by asking what actually drove a 1.11% S&P gain, while the Nasdaq went nowhere. Now you have the answer. It was not tech. It was a VIX that broke below its stress threshold, and it was capital rotating into the sectors that do not dominate the headlines. Whether today holds is a 48-hour question. The follow-up video will look at what happens when these rotation signals fail, and how to tell the difference before it costs you. Subscribe so you do not miss it.